In 2019, a man named David signed a contract transferring his $3.2 million manufacturing business to his son. The sale price? $1. His accountant wasn't panicking. His lawyer wasn't stopping him. They were the ones who designed the strategy. That $1 didn't just buy a company. It bought something the IRS can't touch. Most people think wealth is about how much you sell things for. Bigger number, bigger win. But the people quietly accumulating the most, the ones building multi-generational wealth while you're reading net worth calculators, they've known something for decades that nobody teaches in school, in any finance course, or in any book sitting on the shelf behind a YouTube thumbnail. The price tag is a lie. It always has been. Here's the legal architecture behind it. There's a principle most people encounter exactly once in their lives, usually too late to use it. It's called nominal consideration. In contract law, a sale is only binding if something of value is exchanged. That value has no legal minimum. $1 qualifies. That sounds like a technicality until you realize it's the structural foundation of some of the most sophisticated wealth transfers in American history. In 1994, Bill Gates' parents leveraged a family limited partnership, a structure that allows assets to be transferred at a legally discounted valuation, to move wealth across generations below taxable thresholds. They didn't do it because they were struggling. They did it because the tax code treats a sale fundamentally differently from a gift. A gift above $18,000 per year in 2024 triggers the federal gift tax, up to 40% of the transfer value. A properly structured sale, even at $1, does not. Not if the economic substance is real. Not if the documentation is clean. Not if the right entities are in place before the transaction happens. That's the first crack in everything you thought you understood about selling. Here's where it gets more interesting. When David sold his business for $1, his son didn't acquire a company. He acquired the trajectory of a company. The $3.2 million valuation was a single frame, a snapshot of one Tuesday in 2019. What actually changed hands was the entire film, the future revenue, the compounding growth, the multiplying equity. Over the next decade, that business generated over $14 million in net profit, none of it subject to the 40% estate tax that would have triggered on death transfer. All of it now building inside the next generation, instead of being carved at the handoff point. The $1 price tag didn't reduce the value. It redirected the trajectory of that value, permanently. But there is a cost. There is always a cost. The IRS has a doctrine called substance over form. It means they look past the paperwork and into the economic reality of a transaction. If a $1 sale exists solely to avoid taxes, no real business purpose, no genuine risk transfer, no actual economic substance, they can unwind it entirely. Treat it as if it never happened. Issue a deficiency notice. Add penalties and interest going back years. They've done it thousands of times. David's sale held up not because of the dollar figure. It held up because of the structure built methodically around it. Which leads to the mechanism that actually works at scale. It's called a grantor-retained annuity trust, a GRAT. Here's how it functions in plain terms. You place appreciating assets into a trust. The trust pays you back a fixed annuity, a predetermined return, over a set number of years. At the end of that term, whatever growth exceeded your annuity rate passes to your beneficiaries completely free of gift tax. The IRS sets the minimum hurdle rate, called the Section 7520 rate, and when that rate is low, almost any appreciating asset clears it. Jeff Bezos has reportedly used GRATs to transfer hundreds of millions to heirs. So has Peter Thiel. Virtually every billionaire whose estate planning has leaked into public record. They are not cheating. They are reading the same tax code that everyone has access to, and they are reading it with better preparation. Now stop, because What you're about to assume is exactly wrong. You've been picturing a $3 million company, a team of white shoe attorneys, a Greenwich zip code. That's what this strategy is supposed to look like in your head. Here's the actual number. GRATs can be structured around assets as modest as $50,000. Family limited partnerships can be initiated with a rental property, a business interest, a brokerage account. The $1 sale framework, moving appreciating assets to the next generation before the appreciation triggers a taxable event, works identically on a $200,000 duplex as it does on a $200 million private equity stake. The math is identical. The structure is identical. The only thing that changes is who knows it exists. And that is not an accident. The financial education system is optimized to teach you one thing: maximize the sale price, negotiate hard, capture value. Every dollar left on the table is a failure. That framework is real, and it is specifically calibrated to keep you transacting, always triggering taxable events, always selling at peak value, always handing the government a seat at the table you spent 30 years building. The people at the top of the wealth pyramid aren't selling at the peak. They're transferring before the peak, moving assets before the full appreciation is realized, structuring ownership before the taxable gain exists. They are selling everything for $1, and they are winning on every single deal. Here is where it stops feeling clean. Every tool described in this video is completely legal. Congress wrote these rules. Lobbyists shaped the language. Donors funded the campaigns of the people who voted yes. So when a billionaire family uses a GRAT to move $400 million across generations with zero gift tax, they are not breaking a law. They are using a law that was specifically designed to be used this way, by people with enough institutional access to shape the design in the first place. That is a genuine opportunity for anyone who now knows these structures exist. It is also a fundamental asymmetry in who actually builds wealth across generations in this country. Both things are simultaneously true. You don't get to pick one. For every David who had a sophisticated attorney in 2019, there are 10,000 small business owners who sold at full market value, paid 20 to 37% in capital gains tax, wrote the government a check representing decades of compounded effort, and called it a success. Not because they weren't intelligent, not because they weren't ambitious, because nobody told them the price tag was negotiable. You now know the price tag is negotiable. David's son is in his early 40s. He runs a company worth somewhere north of $20 million. He did not inherit it. He received a $1 contract, a structure built by a patient attorney, and the knowledge of what came next. The wealth didn't appear from nothing. It was engineered, quietly, legally, and completely out of view of every personal finance influencer who ever told you to max out your Roth IRA and consider the conversation closed. The wealthiest people in the world are not better at earning. They are better at not losing. That distinction is the entire game, every single time. So here's the question you need to answer before you close this video. If a completely legal structure existed, one that had existed for decades, that could transfer your appreciating assets to the next generation with dramatically reduced tax exposure, but required $3,000 to $6,000 in legal fees upfront and the willingness to relinquish direct control of those assets today, would you do it? Or would you wait? Convince yourself it's built for someone richer, someone with better advisors, someone who has more at stake. Because the only thing separating the people who use these tools from the people who don't is the honest answer to that question. The price tag was always a lie. You're either writing it or paying it.